Yo, what's up, everybody? It's Friday, October 25th, game one of the World Series tonight. New York Yankees versus Los Angeles Dodgers. You could see who I'm rooting for. I think the Yanks are going to do it in 7 games. That is my prediction. Yanks, the winner of the World Series, the winners of the World Series in 7 games. Let me know who you got. I'm really excited. The last time these two teams met was in 1981. The Dodgers won that. And I remember the series back-to-back in 1977 and 1978. I was actually living in Los Angeles at the time. And, you know, those were the days of Mr. October, Reggie Jackson. The Yanks won both of those series. They were incredible. So I'm excited about that. I don't know if you guys are going to be watching it, but I definitely will be tuning in. All right, let's talk about the markets today. We had a positive close of the NASDAQ. We had the Dow sell off. I think S&P was down slightly from the last time I looked. Another one of these mixed closes. I think we had a very down week for the Dow, actually. In fact, the Dow's performance pretty much erased the whole entire last months of gains, and that's probably due to the rise in interest rates, the backup in yields that we've seen ever since the Fed cut the rate on September 18th. By the way, the rate cut, the futures markets, Fed fund futures are still pricing in 2 more rate cuts this year, one on November 7th, right after the election, and one, I believe it's December 16th. I have to go back and check the actual date, but we're still looking at 2 25 basis point rate cuts. And I'm going to talk about that in a second. Let me address that right now. You know, the beauty of what I do, at least to me anyway, is that my approach is formulaic. Okay, it's based on data, it's based on numbers, it's systematic. Yes, there's an analytical component. Of course, I have to understand how policy, fiscal and monetary policy, how they work, all right, which I do because of my MMT understanding. I'm not, in that category of people like these zombie monetarists who, they use single variable analysis. The only thing they look at is the liability side of a balance sheet. Debt. They're always talking about the debt time bomb, like all of this stuff. When you have an understanding of the monetary system and how it functions, you're in a much better position to, have some kind of an analytical framework that's going to work out, because, it becomes almost like physics. You have a force applied to a situation, and you could measure, or you could determine or predict which direction, the magnitude, etc. So I like the approach that I have. Like I said, it's formulaic. I can tell you right now, because I always say, I need to see a certain amount of data. I need to see the trend in the data. I never jump in without having as much information as I possibly can. I don't kind of speculate, if you want to call it that way, emotionally, like, hey, maybe this is going to happen. No, the beauty is when you understand how these policy shifts impact economies, then, like I said yesterday, you wait, because the policymakers, they tell you what they're going to do. The Fed tells you it's going to increase rates or cut rates. The government, Congress, tells you when they, pass a continuing resolution or a new budget or whatever, or when new taxes are proposed, or tax cuts, or some additional spending. So, once you know that, you have a set of data, of numbers that you can now track, and you understand the impact it's going to have on the economy. Like I always say, fiscal, the government, is the first derivative, at least for the United States, okay? Because the net spender, the entity that is the net, if somebody's buying, somebody's got to be I mean, if somebody's selling, somebody's got to be buying, right? The government of the United States is the net spender, not just for the United States, but basically for the world. All these other countries, they're basically running positive trade balances, positive current account balances. So it's U.S. government spending that literally finances the trade surpluses in all these other countries like China and Japan and Germany and all these places. In Germany also, it's the other Euro countries that finance Germany's production. So I've been talking about this bond trade now for a while, and we've seen rates backed up. I see now, as I told you guys, even before the rate cut happened, way before the rate cut happened, I've said to you guys that once they start cutting rates, we're going to see a reduction in these interest income transfers into the economy, which those transfers were fundamental in pushing the stock market to record high after record high after record high, and fundamental in sustaining a positive economic growth once the COVID stimulus expired. Okay, remember, when the COVID stimulus expired in 2022, we were starting to go, I think we did have a quarter or so of a contraction. And it was the increase in these interest income transfers, which supported the economy, turned it around significantly. And since then, it has been the support, because I've been telling you guys, we had, and it's funny because the media makes a big deal out of this, but in a negative sense, they're like, oh my God, there's the interest the government is paying is more than defense right now. Yeah, that was the same exact thing that happened under Reagan, and we had the Reagan boom. I even mentioned that in videos in the past about the Reagan boom and how the biggest line item of expenditure in Reagan's first term was interest expense because of Volcker, who jacked the rates up to 21%. All right? And that's what fostered the Reagan boom. Those were those massive interest income transfers into the economy. So I said, once the Fed starts cutting rates, first of all, I said that the year-over-year gain, once the Fed stopped raising rates, which was, it was at the end of last year, at the end of 2023. Once they stopped raising rates, we saw this year, it took a little time, but we saw that the year-over-year increase in interest income transfers, they started to plateau out. It wasn't accelerating anymore, okay? It plateaued out at a high level, but nevertheless, it plateaued out. And now we're starting to see, it's incremental now. I said, like, we're down something like 12 billion over the last 4 weeks, basically this month. This month is the first month of the new fiscal year. We had one rate cut in September. Interest income transfers are already down 12 billion. So we're running at about, right now, we're running at about a 3 billion per month reduction. 3 billion per week reduction. And we have spending now is about 25 billion over last year. So leading spending is 25 billion. Let's call it 25 billion. We're shrinking the transfers at 3 billion a week. Okay, that's 12 billion a month. So do the math. Basically, in 2 months, that spending increase gets wiped out. It goes flat. And after 2 months, and this is only with the one rate cut, okay? Once you get another rate cut, and then another one in December, that drain is not going to be 3 billion a week. It'll be 5 or 6 or more billion a week. And we're going to start to get that shrinkage in the year-over-year comparison of total spending into the economy. So I can tell you just by this, I can give you a date. If we're just going with the one rate cut right now, let's even assume they're not even going to do another rate cut. If it's going down at 12 billion a month, in 2 months or 2.5 months, we've eliminated the additional spending this year. After 2.5 months, you're having a shrinkage in spending. So what is that? That takes us into January. We're in the end of October, November, December. By the end of December, we're flat. January, we're shrinking. And if we have 2 more rate cuts, which that's what the market is pricing in right now, then that shrinkage, that's going to happen faster, and it's going to be bigger than $3 billion a month. So because my thing is formulaic and is based on numbers, I can tell you, like I always tell you, dates based on, we have cyclical things that happen with tax drains. We have cyclical things, quarterly things that happen with quarterly interest payments, stuff like that. I always tell you, like, way in advance. It's not one of these things like, just wait, it will happen. I say, these are the dates, okay? I said, once the Fed starts cutting rates, we're going to start to see that shrinkage. Actually, it's even more than I thought right now. I mean, $3 billion a week after that one rate cut. See what I'm saying? So, like, it's formulaic. You have numbers. It's science. I'm telling you, it's science. And the hard part is just like I always say, the hard part is just, it's just letting it happen. It's being patient. Now, with me, I tend to be early on these things because, like, I see them coming together. I don't like, I'll be honest with you, okay? I don't like to get caught up in kind of like what the crowd is doing. But at the same time, I understand that the crowd, because they don't understand this, they can push these things beyond the point where they make any rational sense based on the numbers again, okay? They're doing it based on FOMO, fear of missing out. They're doing it based on a headline. They're doing it based on some, technical indicator, like a moving average or something like that. So it's like, even though I could say, oh, I see this stuff coming together now. It's going to represent a major, major change. But I'm not going to do anything right now because I understand I also understand what the crowd is going to do. People have knocked me for that in the past. And I'll be honest. That's probably a legitimate criticism. I mean, I'll take it. But at the same time, I have to say that I got to be myself, okay? And I feel uncomfortable being with the crowd. Let me repeat. I feel uncomfortable being with the crowd. So, like, if that means I'm going to be early on these things, I'm just going to have to deal with that in my own way. I don't get overly aggressive at the beginning. I watch the numbers. I give it time to develop. I see what's going on, where a particular a trend or market environment could continue beyond, the point where I thought, hey, things are, or beyond where I'm seeing where it's starting to change, because the other, the 99%, the 100%, they're not understanding it this way. Just like they didn't understand with the rate increases, where I was also early on that in 2022. I mean, I should go back and look at some of my reports from 2022 or some of my videos. But I was saying, you got to buy this correction. You got to buy this negative reaction. I was talking about guys like Mike Wilson at Morgan Stanley, who was like this perma bear, this super bear. He was in the headlines every single day on Zero Hedge and all the financial sites saying like it's going to crash and a giant recession is coming. And, I was early on that, but I was right on that. If you had to think about where the market is now and think about it where it was in 2022, all right? And I'm sure if you invested in 2022, based on whatever, not even necessarily me, if you invested back then, you feel really, really good now. about where it is. And I'm saying the same thing, but in an opposite sense. Once we start to have this drain, and again, I'm gonna qualify this with one thing. After the election, we got to see who wins, what economic policies are proposed, and what gets passed in what form. There might have to be some adjustments made next year. But I keep telling you guys, we got certain things next year that are, literal. I'm not going to call them time bombs because that's like a stupid metaphor and it's overused. It's too hyperbolic. It's too emotional. But, some drags on growth. I've been talking about it. Smaller COLA increases for Social Security and those programs, the expiration of the Trump tax cuts, more rate cuts. I mean, bullet points. I've been giving you exactly why. Not just because, it's going to crash because it's too high. I never say stuff like that. That's not analysis. I never say stuff like that. I say, here are the things that are going to happen that are going to dictate the economy and how it's going to look in 2025 or whenever, in the next quarter or whatever. So that's where I'm at right now. Anyway, it's Friday. Please like and subscribe. Thank you very much if you've already done that. And watch the game if you can. Go Yankees. See ya. Bye.